Good morning, thank you. I think we're ready to rock and roll. Thank you for coming to our session, which is Overcoming Barriers to ESG Integration in Equities and Bonds. My name is Michelle Clayman. I'm the founder and chief investment officer of New Amsterdam Partners, which is based in New York. My distinguished panelists have come in from all over the place. So Andrew Canter has come in from South Africa. Christopher Greenwald has come in from Zurich in Switzerland. Mary Jane, she and I see each other two places, both in New York City and in the basement of the toy store in the little town where we vacation separately. And then Lupin has come in from London. Unfortunately, Matt Orsag from CFA Institute is not able to join us due to a lady named Florence, the hurricane. The good news is it's been downgraded to a 3 or a 2. The bad news is it's supposed to drop about 30 inches of rain, and he's not sure, even if he got here, that he could get home. So today is a momentous day in that we are seeing the publication of a couple of PRI reports. One is the Americas report, and then we also have another report coming out. ESG, one is the ESG integration in the Americas market practice and data. And then there's also a case study volume, guidance and case studies for ESG integration in equities and fixed income. I'd also like to acknowledge the unsung hero of this project, and that is Justin Sloggett. Justin, are you around somewhere? Yeah, Justin is in the back. He put in a huge amount of work on these reports. Now, Matt Orsag was going to go through the slides, but in his absence, I will do that. So firstly, to give you a sense, this was done with CFA Institute, which, as many of you know, is the premier organization for those of us in the investment business. And the idea was to understand the state of ESG integration in 17 countries. And we wanted to go out and not just survey ESG specialists, because we know that we are all true believers. We wanted to go out and survey CFA members. We, in the end, got 1,100 responses from CFA members, of whom only 9% were themselves ESG specialists. 23 workshops across the globe, including 3 in emerging countries, in China, India, and Russia, were held. Mary Jane and I participated in the New York City one. Then there are a number of publications that came out, the case study report, which is available on the app if you can read complex reports on tiny phones. The Americas report, out today. The EMEA report was released in December, and the APAC report was released in February and March. Just to go over it here, you can see the distribution of respondents, and it's great to have a slide with teeny-weeny numbers which no one in the back can read. But what you'll see is that about half of the respondents were asset managers. We did get fairly senior level people. 19% were portfolio managers. 13% were analysts. So we wanted to know what are the main drivers to integrating ESG issues, and 2 things came up, and they were consistent between equities and fixed income. So firstly is risk management, that people are recognizing that if you don't pay attention to ESG issues, that can create problems for your portfolio. The other is client demand. Then we looked at what are the main barriers to integrating ESG issues into the investment analysis of equity and fixed income. And again, pretty consistent. So the number one reason was limited understanding of ESG issues and integration. The second was lack of comparable and historical ESG data. And then the third was a lack of company culture. So in our panel today, we're going to, maybe I'll go back to that slide, we're going to dig down into some of these. And I'm going to start the discussion with the third thing, because I'm sure you all know the phrase, you can take a horse to water, but you can't necessarily make him or her drink. So, you know, if you don't have a culture which embraces ESG, what do you do? So I'm going to turn it over to Mary Jane. So can you talk about creating culture?
Sure. Thank you very much, Michelle, and good morning, everyone. Thank you for coming to our session. I know we were planning to talk about two of the three barriers shortly, which are a lack of understanding of ESG issues and lack of company comparable data. But we also thought it was important to start with company culture, because underlying the barrier in many situations is the company culture being lacking at the organization itself. And so when we think about the CFA survey, the Institute survey, the vast majority of respondents were asset managers, but the barriers that we are going to discuss today could also apply to asset owners, to consultants, and to sell-side analysts. And so when we're thinking about what does lack of company culture mean, in many cases we think it means that it's a lack of ESG mindshare in the organization, that there is discrepancy and disruption in how to think about ESG across the culture. And oftentimes that culture is set by the CEO. And so if there's a lack of company culture or support by the CEO, it makes it very difficult for the investment professionals at the organization to carry out the mandate of thinking of ESG factors. Without the support of senior management, there are a number of reasons that have come up individually by the investment professionals, and we've heard a number of them, including that the portfolio managers think that being inclusive of ESG will hurt their own performance. So they don't want to touch ESG because it will hurt the performance. We've done it fine all along, so why do we need to change? I don't want to do ESG, I don't understand it, and so we should hire someone else or we should outsource the ESG research. The client is going to have to force us to do it because this is not something we normally would do anyway. And there's also the push of ESG integration is often followed or carried out, by a champion or a team. So there's a group in the firm that may support it and try to push it through management, but if that team leaves or there's a change with that team's seniority, then it takes away a lot of the momentum that has been done. So having a lack of company culture is a real challenge for investment managers in terms of making anything inclusive and holistic. And another way of thinking of lack of company culture in terms of ESG mindset is the idea that it's separate, that the investment approach or investment thinking is here, and that the ESG analysis or understanding of long-term ESG issues is over here, that it's outside of their scope. And that's a very big barrier. And this is what we've been working at with the CFA Institute and with the PRI signatories, is trying to bring those two sides together. And I know many of us in the room have already been in this discussion for many years, but to actually get the practice in place at the firm is somewhat nuanced and something that could take years to actually have in place. So I was asked to talk about ClearBridge, or my firm, and how we can show some of the solutions that we found in terms of company culture. And so just for background, ClearBridge is an active equity manager. We have 30 years of ESG investing experience, and we're headquartered in New York. And we have $140 billion in assets under management. I personally have about 22 years in only working on ESG portfolios. And so I can say from the years of experience that as you embark on ESG integration at your firm, it is something that you have to plan for the long term. So as long-term investors, and if you're planning for the long term, then this should be possible. So a quick way, just to wrap it up very quickly, that you can think about ESG at the firm is the idea of having your financial analyst also be the ESG analyst, having the support of your CEO, which we absolutely have, having the support of the CIO and the Director of Research. All the financial analysts who are integrating ESG should roll up to the Director of Research for oversight and guidance. The analysts should also be involved in the engagements directly. They should have to publish on their ESG research within the investment framework. And this will help to set a culture that this is a continuity approach and this is something supported around the firm.
Great, thank you. So, Chris, how have you turned this barrier into a driver at UBS?
Yeah, I mean, I would certainly agree with the comments about senior management leadership. It's absolutely key. We are fortunate enough to have the support of our CEO and chairman with regards to sustainability. They made a very clear management decision about 4 years ago to link the sustainability strategy of UBS Group with investment processes, product development, et cetera. And so that led to the creation of an organization called UBS in Society, which brings together representatives from all of the business units, investment bank, wealth management, asset management, to share best practice ideas, the latest innovations. It's led to a lot of collaboration across the different business units. So it's really been a firm-wide effort, and that's definitely been a top-down led, which is extremely important. Bottom up, it's been essential to have this included in the analyst incentive scheme. So we now have incentives for all of the analysts in fixed income and equity research to integrate sustainability, so it's part of their annual evaluations. That's absolutely important. Also in terms of how it's presented, especially at a large mainstream firm, it's really important to re-emphasize the message to the analysts and the portfolio managers that it's not about negative screening, it's not about limiting choice, it's about adding material information to the perspectives of the analysts so that they can adopt a more long-term view of company evaluation. So it's enhancing the work that they're already doing. And I would echo the point about engagement. We've found with the analysts, it's been very important to get buy-in because they've seen that by including sustainability in their engagements with companies, it's improved the quality of their conversations with management. They're able to get a better insight into long-term strategy. They're much more likely to get meetings with independent board members. So including it in the engagements and dialogues with companies has definitely enhanced what they've been doing. So I would say just approaching it in terms of not a change, but rather an enhancement of the existing investment process has been absolutely key to get buy-in from the investment teams.
Great, thank you. You mentioned materiality and data. So the number 2 barrier was lack of comparable and historical ESG data. So how do you turn that around? What's the solution to that?
Yeah, this is obviously a big topic. We were
Right.
discussing it for the first 30 minutes before the panel started. I think there's 2 issues here that we have to distinguish. One is the availability of the data and information. And I think on that front, we've pretty much solved a lot of the main issues. I mean, the main research providers on ESG now have coverage of 7,000 to 10,000 companies. We have pretty much complete coverage for investment grade credits. We have very good coverage for high yield. We can now integrate this into fixed income processes. Most mid and large cap companies now have sustainability disclosures, a core set of GRI metrics that they've included. So I think on the data front, a lot of the issues have been solved over the past 10 years. The biggest challenge I think that the mainstream investment industry needs to overcome is a false expectation about what ESG data and ratings can provide. And we need to be clear about where data ends and where the investment analysis and process needs to begin to overcome this barrier. So what we do with the analysts is we very much emphasize some of the limitations of sustainability data and ratings and what their job is to overcome this. So I'll mention kind of the 3 most important things that we emphasize in training the analysts. First, the sustainability data and ratings are by necessity historical. They're made up of reported KPIs from the sustainability disclosures of companies. information about controversies in the public domain. This is all important information, but it's by necessity historical. And every buy-side analyst needs to have a recommendation about the future and where the company is going. This is just the nature of investment analysis and recommendations. So the analyst's job is to take that information and then apply it to their scenario analysis going forward. Secondly, the ratings and the data are still far too broad. They're trying to cover too many issues for the analysts. They need to focus on the 3 or 4 key factors and metrics that can really make a difference from a financial perspective. And so we've developed a materiality analysis that we use internally for over 35 industries to help the analysts really focus on those metrics and factors that can make a difference in terms of their models and assumptions. And then thirdly, and perhaps most importantly, the data and the ratings are almost by necessity disconnected from the investment recommendations themselves. It kind of gets you to a Bloomberg level of ESG information, but the analysts need to take the next step and apply that to their investment recommendations. And so rather than taking the existing data and ratings and trying to just plug it into an existing investment process, we work with the analysts to change how they're valuing the companies and then have them do an assessment themselves in terms of the sustainability profiles of the companies as it impacts their financial assumptions, and to be explicit about that. How is it impacting their assumptions around the growth rates? How is it impacting their assumptions around cost? How does it change the risk profiles of the companies? And so we get a signal coming from the analyst team that's much more useful from an investment perspective, because it's coming from our buy-side analysts who have on average 20 years of experience. They know the company's the best, they know the industry's the best, they know management. They're the best place to make the assessment of the sustainability profiles of the companies from a material standpoint. And we found that by involving the analysts in this process and actually doing the assessments themselves, it gets them much more involved. They take ownership into the ratings and they get much more enthusiastic about the whole integration efforts.
Great, thank you. And of course, we know across different rating services there can be very different opinions of companies, different ratings. So let me go to you, Lupin. Is the data the issue or the methodology the issue?
So I think that when it comes to data, there's always challenges, particularly when you're looking at sovereigns, and you're looking at factors that can often lie latent for a very long time, resulting in multiple disequilibria. But then when they do come to the surface, they can really have a very negative left tail impact. But to me, the data itself is not the key challenge. I think that the quantitative data that is out there is relatively good quality and relatively consistent in terms of its coverage to offer a deep insight into how ESG factors should affect sovereign credit outcomes. What is challenging, I think, when you're thinking about integrating ESG into sovereign analysis is the materiality impact. And that is something that really requires very solid and deep frameworks for thinking about various risks, which are going to differ across sovereigns and across time. So, one of the key challenges that we found is due to the lack of deep analysis from the industry itself. So the rating agencies really focus more on the ability and willingness to repay rather than a more holistic sense of all types of risks, including ESG risks. And also some of the more ESG prone data providers really don't have the qualitative analysis behind forecasting what will happen in the future. So we've had to bring a lot of that analysis in-house. Now at PIMCO, we have a very large team of analysts, and we're able to do that and integrate that into our usual credit work. The challenge, I think, is really when you're looking at very, very specific projects, specifically at the municipality or local government level, to have enough information and enough expertise to really make a solid investment decision. And that kind of dovetails to the broader issue of, how do you convince investors that ESG integration into credit research really will have a material impact on the risk reward of their investment decisions. And what we found is integrating ESG factors, particularly governance and social factors, has in the past been a very solid leading indicator of credit quality in sovereigns over long periods of time. I think the next leg to focus on, and it's one of the survey results, is that environmental issues are likely to be the next focus in terms of materiality in the future. And that is where we're putting a lot of focus on in terms of how we think about the more latent, diffuse environmental risks and how they affect credit risk.
Great, thank you. Andrew, Lupin says that data is not the issue, but do you see variation in the quality of data across the fixed income asset class?
So there's some real wisdom here, and it's interesting that we're all very much aligned. The culture is a choice, right? Your purpose, your mission, your culture. I'm going to get to the data, I promise. But start with the culture of the organization and start. But I think one of the things, and we talked about the client resistance, we get no client resistance because we have good performance. Clients want outcomes, and that's what they want. And I think the mistake many of us make in this room is we don't start with a statement that we're all about being at the top of the performance table, right? You have kids, you must feed them, and you must educate them. We must earn good returns, and we must be responsible and sustainable investors. It's not an if and either or, and I think that confuses clients, and it's all of us having a bad message. So we'd start, please, with performance. So that obviates the client discussion. We don't ask clients whether we should add a new analytical tool. We're trying to all build new analytical methodologies here that give us competitive advantage and better returns. So that's the starting point. Now, it's in the subtext of what we've heard so far. Now, when we get to the data, look, ratings agents I'm a credit guy, right? So agency problem. I don't trust credit ratings agencies. They're data, they're information, they're another set of eyes, but they are not the answer. As you observed, you must integrate it into the analytical process and use that data. I still find that a lot of the data is still we're still at the stage of heuristics, how companies behave, judge it. I mean, in credit, your 3 C's of credit are capacity to repay, collateral if they don't repay, and their character, their intent to repay, their integrity. We don't have good character tests. All of the ESG ratings assessments and the 800 factor checklists aren't going to tell us the character of entities. It is never going to give us that insight. We have to exercise a different level of engagement and oversight and understanding, and that is heuristics. It's how they behave in practice, how they deal with you, how they choose to report, how you read their reports, and the veracity, the truth of what they're giving to you. So I think that's the flawed data. In fact, somebody want to make some money? Please come up with a psychometric for corporates. Psychometrics, that's a better answer, and we don't have it yet.
Okay, so yesterday I was chatting with Justin, and he may have had too many cups of coffee, but he came up with a killer question. So let's suppose that God or whomever suddenly gives us perfect ESG data. How do you think that would affect the market? Nothing?
No, it's just more information. I mean, the analyst's job is to exercise judgment on a range of factors: financial, operational, strategic, managerial, competitive advantage, environmental, social, governance, and there's a few more I can't think of right now. That's the analyst's job. So I mean, I'm not even sure what perfect data is actually in any of those realms. And it's your job to integrate all that, determine risks, price for risks, and make investment decisions. That's where I would start. I think there's broader macro problems around that. The construction of indices is a problem, because even if you hate a company, if you're index cognizant, you're stuck with holding some of it, right? For example, now in credit, I don't have to do that. In fact, anybody, if you haven't figured out yet that credit indices are death, just write that down. Credit indices are death. So I don't live in that world. But as an equity manager, I would hate to be benchmark cognizant. I think there's some broader issues than just the data. It's how you price for that risk is probably the bigger challenge.
Right. I'll come back to benchmarks and returns in a moment, but if you suddenly got really great data sets, do you think it would have a measurable impact on the segment of the market that you operate in?
I mean, from my perspective, in the sovereign space, no, not really. I mean, what I would like a indicator for is, how a new government is going to behave, or who will win an election, which is impossible to predict. Because in the sovereign space, the information asymmetry is really on the governance side. So the big tails and the big cliff events happen when you have changes in public policy, because you have a new regime coming or an old regime is toppled. And that is part of a regular credit analysis, which integrates these political scenarios into a probabilistic framework of various outcomes. So I think for the sovereign side, the uncertainty will always remain regardless of how good polling data you collect, because as we know, polls don't really have a very high success rate currently. So for the sovereign side, I don't think data itself is the issue.
Okay, great. But Mary Jane, speak up for us equity people.
Oh, sure, thank you, and I'll be brief. I think having great data would be very, very helpful, and I think data is one point, but part of the barrier of ESG integration is not access to data, because there's plenty of data, even perfect data could be out there. What the barrier is integrating that data into your investment process. And so this is why we believe that it's very important to have the fundamental analysts, the financial analysts, understand the context of how to use that data. Data in and of itself is not helpful, but if you understand how to utilize that data and appreciate where you can find value from that data, that is something that's more helpful. So the fundamental analysts will take an approach to say, what multiple should I assign to this? How should I use this data to think of what are the longer term risks versus the shorter term risks? Is this more of an environmental materiality, or is this more of a social materiality? These are decisions that an analyst with experience has to make, but can only make through in-house training, as we talked about, through incentive compensation and performance review. And I don't want to say only, but it very much helps in the starting process as your organization is trying to lay out what is the company culture, what are the barriers, and how can our analysts use this data in a way that helps in the stock selection and in the investment process for long-term returns.
Yeah, I mean, I would completely agree with that. That just data alone is not going to move the markets. Having more asset managers integrating this into the way they're valuing companies will, and already is. It's beginning to happen, which is encouraging. The other thing I would just emphasize is it's not simply about an external data source and then incorporating that into the process. It's also about the analysts utilizing all the pieces of information that they have about companies. It's not that they haven't been thinking about sustainability issues at all, but they may not have been doing it systematically as an explicit part of the process. So it's taking those insights and information and putting it into an explicit step in the process to make sure it's done consistently across the board.
Great.
And turning it into basis points of required return on equity or yield on bonds. I mean, it's art as much as science. And there's some volatility measure you have to put in there.
And the big canard in ESG is people say, oh, well, it's going to produce negative returns. Now, I've been managing ESG assets for over 20 years, as well as unconstrained assets. What I've found is the ESG portfolios, if anything, do a smidgen better than the unconstrained. But it is a huge issue, a negative perception out there. And Andrew, you mentioned the whole benchmarking thing. So we're now all hostages to our benchmarks. Well, you're not, but we equity ladies are. So how do we deal with that?
I can't solve your equity problem, except to say that you're the only time you're allowed to negotiate with your clients. The only time you can ever negotiate against your clients is on fee and mandate. So I would just put that out there. You know, if you don't like your benchmarks, negotiate away from them. But okay, I'll leave that.
Well, yeah. Then they may say, well, our search was for X, Y, Z.
I get it. So it's really difficult, though. I mean, because you are benchmark. So many of you would have heard the name Steinhoff, South Africa's own Enron, went bust in December last year. Hundreds of billions of rands, which is quite a lot of billions of dollars as well, by the way, lost in this sort of fraudulent pyramidal structure thing. We assessed their governance as terrible in 2008, and we embargoed lending to them in 2008. Okay. Now, if I were an equity manager and I did that, went to 0.8 in 2008 when the company was rising a percentage of the index, like up to 6% at times, we would have been dead. We would have been fired in 2012, right? So I have a real sympathy for equity managers who are slavish, who have to be slavish to these benchmarks. It's a terrible problem. And again, it goes to how your clients spec the mandate and what your bet size are allowed to be. Look, the whole active-passive debate forces active equity managers to be more active now anyway. So it may be a good prove the case. Maybe ESG doesn't have to be a smidgen better. Maybe it can be a lot better if you take bigger bet sizes. That's the thought.
Yeah, Lupin.
Go for it.
So,
And then we'll come to Mary Jane.
look, I think the issue about negative returns is a bit of a, it's something that we don't really face as much in terms of direct questions from clients. I think most clients recognize that ESG is a bit more about than just doing good, that it does add value in terms of the credit process in the sovereign space. So, for us, that really isn't a big area of debate. I think the bigger area really is, to what extent can you actually differentiate between countries, particularly in the lower end of the spectrum. For example, if you have an EM sovereign mandate, where governance factors are a lot weaker and social indicators are a lot weaker than in developed markets. So I think there the question really is, how should we think about countries that have poor initial conditions, and how can we engage and have an impact in terms of changing behavior for the positive? JP Morgan has got quite a detailed study on the fixed income space in EM, which shows that integrating ESG indices versus the regular standard EM indices actually does increase alpha and reduce the downside during very negative markets. So during the 2008 crisis, 2013 taper tantrum crisis. So I think the research out there still minimal, but suggests that isn't really a key issue. When it comes to benchmarks, this is an issue regardless of whether you have an ESG mandate or not. In the EM space, I think the challenge has always been that higher yielding countries tend to be the ones with worse ESG scores. So if you are underweight or avoiding them, what do you replace that exposure with? And I think their flexibility with the mandate and discussions with clients that are open to ESG bent, ESG kind of slanted investment horizon really helps. So you can say, look, we don't want to invest in country X because of X, Y, Z. Yes, it's yielding double digits, but we can replace that exposure with a quasi-sovereign in country Y, which is yielding something very similar, but the governance structure, the social indicators, the environmental impact of this particular corporate is a lot better. And that's where I think discussions with clients really, really help.
Yeah, and before I come to Mary Jane, what I would say in client meetings, my clients love it when the ESG considerations added to returns, and they're always, like if they detract it, even if you tell them exactly why, they're like, oh, should we revisit these guidelines? It's like, no, you chose the mandate to invest with a certain set of values, but unfortunately there's a problem with short-termism, particularly in the US markets. So Mary Jane, how do you counter these objections?
I had a visceral reaction when Andrew said, maybe you have to take bigger bets. And I was thinking, as a long-term investor, we are still fiduciaries, and we don't like to think of it as bets, and I don't think you meant it literally as bets.
Sorry, I meant bet size relative to benchmark.
Right, so
as opposed to being benchmark hugging.
Right. So I think there's a good combination of both, where you are aware of your benchmark, but that you are actually very high conviction in your holdings and you understand why you own the stocks that you own. And as long-term investors, I think it's very important for us to take the fundamental analysis and take the fundamental approach that this is going to add value, perhaps to reduce the amount of risk and also help us find opportunities. But that said, the amount of volatility that you're willing to take into the portfolio is not necessarily a bad thing. There are different, as we know, clients have different time horizons and different appetites for risk. There are very good ESG strategies where you can perform very well according to the benchmark, and you can outperform by a smidge or a lot, depending on the market. But what you want to have is a process in place that's repeatable and that's consistent, so that when we go through the bull markets, we go through the bear markets, we go through instances where there's an eruption, whether it's a Volkswagen or the company you had mentioned, that this is something that ESG will be able to perform on a consistent basis. Also, what's interesting with ESG is that with some of the smaller companies, that they may be perceived to have higher volatility. The higher volatility for those smaller disruptive companies that will be the next Google or be the next Tesla, these are companies that I think from our perspective as ESG investors, we also need to do very thorough fundamental research, but we also need to apply capital to incubate some of those earlier adopters or those earlier companies that are disruptive. So in terms of performance, you can manage portfolios where you have the very large companies that have a lower risk assignment, but then you also can invest in companies that are going to be future growth companies.
Chris?
Yeah, I mean, in terms of our own work, we've certainly found there is a positive signal that comes from sustainability over time. You need to look at it across different market cycles, et cetera, but just integrating it into indices, we've found adds about 60 basis points on an annualized basis. It's important that to note that a lot of the stock selection specific outperformance comes on a risk-adjusted basis, which reflects a lot of what the research shows out there, which is the outperformance comes really from avoiding the more risky companies, avoiding blow-ups. MSCI has some interesting research on this. Merrill Lynch just published kind of the Encyclopedia of Quant Studies just 2 days ago, which
And
I
I would
highly
recommend my 2015 Journal of Investing article on exactly that subject.
Okay. So,
Great
you know,
cure
I think,
for insomnia.
yeah, but I think maybe the larger issue here is not a lack of academic evidence. I mean, you've seen these studies that show 90% of studies showing a neutral to positive impact from sustainability integration. I think really, and where does performance come from? Ultimately, for any active manager, it comes from the quality of the analyst team. It comes from the quality of the portfolio manager. It comes from the consistency of the investment process. So to really overcome this, we need to have more mainstream asset managers integrating sustainability across the board to give larger clients the confidence that they can commit significant mandates to integrate sustainability in a way that's not going to harm performance. And just from our own experience, we see this happening in that we have our largest mandate clients asking us to begin to integrate sustainability in various forms and fashion. It may be the existing mandate, or it may be creating a side mandate that's more focused on sustainability or impact investing. And they're willing to do that because they know the investment teams for the past 10 or 15 years, so they have confidence in the investment manager. So adding sustainability to an already very solid investment process, I think, is going to really help tip the balance in terms of moving larger amounts of money in a way that's integrating sustainability.
And yet, well, to your point, the CFA PRI report shows there are a lot of investors out there who haven't even started on this journey. And our number one barrier was limited understanding of ESG issues and integration. So, what's the magic pill to cure this? Chris, I'll come back to you. I was going to say bullet, but that's not a good thing to say in this environment.
Yeah, I mean, I think certainly you find this reflected in the survey results, probably from those managers that haven't started yet or are kind of early in the process. But I think the real way to overcome this, to go back to what I was saying earlier, is you have to involve the analyst teams to be actively involved in assessing the sustainability profiles of the companies as it relates to their financial cases. Rather than seeing it as something external, approach it more as additional information that provides a better long-term view of the quality of companies. And so I think that's really key to overcome this issue, because the analysts themselves become involved in thinking about the sustainability of companies, but really from the perspective of how it impacts risk and return.
And Lupin, what would your solution be?
So I would take a step back and say, so from the fixed income sovereign perspective, we don't typically find that there is limited understanding of ESG issues. So notwithstanding the survey results, in sovereigns, a key issue is governance. So when we have investors that are benchmarking us or mandating us with a sovereign mandate, typically governance and social indicators and environmental indicators are a key factor in how they're thinking about that space. What I think that there is less acknowledgement of is how ESG factors can be can affect other aspects of fixed income investing. So for example, with Puerto Rico in the muni space, I think that that's shed a lot of light that actually these types of governance issues can actually impact what we would previously have thought to be a relatively solid credit. And I think there, the barriers are coming down, but really it's much more, I think, an issue of what kind of asset space your client is investing in rather than a general lack of understanding of ESG.
Okay.
So there's also a long-standing nomenclature problem, right? I mean, because we can talk about positive screening and negative screening and developmental investing and engagement and stewardship. I mean, you have to decide what you're going to be. You know, what are you a developmental investor? Are you a moral-based investor that wants a negative screen? I mean, that's part of the problem, right? It's just how we speak about ourselves and define our. No wonder clients are confused. There's too many names.
Mary Jane.
I think it's a fair point that there is limited understanding in the financial analyst community about ESG issues, but that said, that should not be a barrier not to be overcome. Just like any analyst who starts out with their CFA exams or starts at a firm on the buy side or the sell side, it takes them years to hone their skills and how to analyze the companies or the stocks that they're responsible for and to put client capital in. So similarly with ESG issues, I'm not trying to say it's an excuse, but I think it's something that the analyst has to commit to. And then the analyst commits to it, I am pretty sure, and based on our experience with the CFA and with PRI signatories, that analysts can do this. It's just a matter of incentive and will, and this goes back to the company culture. So is there incentives for analysts to start to do this? Is this more work, or is this part of their work? Is there incentive from the CEO or support from the company culture at the top level? That's also important. But the third part is also the clients. The clients have to also let the managers that know that this is of importance to them, that these are their assets that we're stewards of, that we're fiduciaries for, and that as clients continue to communicate this, I think everyone will be incentivized to learn what they didn't learn before, but it shouldn't be the reason why they're not doing this, because they can learn it.
Andrew,
Can I just jump in? So it's the one word you're not saying is purpose, right?
Or incentive, yeah.
Well, no, you're using incentive.
That's true, that's true.
Organizational purpose drives from the top down. It's the word you're not saying, and it's you know, if we understand our role in the economy as capital allocators to sustainable enterprises, that's a sense of purpose, and I think that drives analysts. I mean, I'm going to work this weekend to do a low-income housing scheme. I don't really want to work this weekend to make corporate executives rich by lending them another $1 billion. You know, so my sense of purpose and my team's sense of purpose drives behavior. I think more than just raw money incentives. Sorry, on clients, it's really interesting. In South Africa, if you look at the PRI statement about, you know, fiduciary duties must include the integration of ESG factors in investment analysis, that is in South Africa pension fund law already. So our discussions with clients are they're trustees and they now have to adhere to the Pensions Fund Act. It's there. We have very healthy discussions about this all the time. There really is not only no resistance, they're really intellectually curious about it, which is a wonderful state of play.
Mm-hmm. One thing that I wanted to mention, which is, you know, in terms of overcoming barriers in the sovereign space, with the focus on SDGs and the potential growth of SDG bonds, I think there's a lot of work that can be done at the industry and the regulatory level to improve understanding of, first of all, how we should be assessing impact, what kind of legislation we should be expecting from various sovereigns, how we can actually have common codes in terms of fixed income documentation, similar to what ICMA has done on the sovereign debt restructuring side. So all of those regulatory plumbing issues, at least when it comes to the sovereign bond space as it relates to SDG goals, I think are quite important things that we can make practical inroads in terms of overcoming investment barriers, say, to ESG.
Yeah, so the tone has to be set from the top, whether it's from government or legislators, and
Absolutely.
in companies, the tone has to be set from the top. I know my own company, it's sometimes good to be boss. I just legislated 12 years ago, okay, all of our research reports, you have to have an ESG section in there. And people are like, huh? It's like, no, we have to have it. Fortunately, I had the data to back up why. But at this point, let's open the floor up for questions. There should be people with roving mics, so please put up your hands and the mic carriers will find you, and please tell us your name and where you're from. Gentleman over there.
Thank you. Is this on? Gregory Elders, JP Morgan. So Lupin, question for you. Thank you for mentioning the paper earlier. So it sounds like you were doing a lot of this ESG already before it was a term. So I guess sort of, is it matter that you've changed internally how you looked at these factors, or the conversations you have externally? So how has sort of the growth of ESG as a term actually changed how you look at these issues and consider them?
I think that that's right. So, as you know, I grew up in emerging markets, and there I think, we've been doing ESG analysis for decades. We just haven't called it that. And so internally, we have incorporated ESG in our sovereign credit analysis and the way we think about sovereign investments for quite a long time. What's changed is how we're actually discussing that, both in terms of interactions with our clients and also interactions with our credit analysts. And also in terms of how we are rolling it out into other aspects of the fixed income space beyond sovereigns and beyond corporates. For example, the muni space, agency mortgages, where you wouldn't necessarily have thought of integrating ESG credit analysis in. So that's where we're really shifting in terms of the way we're thinking about ESG. ESG at PIMCO has not been a siloed entity. It's very much integrated in our investment thesis. And I think that that is one of the reasons why we've been able to be relatively successful in thinking about this across the whole fixed income space.
Lady over there.
Good morning. Kathleen Bachman from Loomis Sales. I wanted to ask you to give a little information about how you think about ESG in your valuation work in credit, sovereigns, and in equities.
So as I said earlier, we integrate these factors, the relevant factors for the industry and the company, into the analysis. The analyst has to do the job, has to present it to the credit committee, and so forth. So we turn it into, what I hinted earlier, it's a volatility measure. So you start with an overall credit assessment, probably default, a volatility of that outcome, and that volatility of outcome gives you can turn that into basis points. So that's actually how we do it. Now, in some companies where we don't feel we can get our arms around the risks of any one of those elements, but more often than not it's going to be a governance risk in our context, we will simply, it's almost like we can't measure it, we won't buy it. But they're below the line. We just say, not interested. Won't even talk to them. I don't have the time. I'm not benchmark cognizant. I'm not stuck with them. I don't have to waste time doing analysis because they're a bad company. Yes, we use that word, bad. So it's turning into basis points, which is, and it saves us, by the way. So another company, it's a good example. Another company in trouble in South Africa now is a huge cell phone operator, MTN, getting into all sorts of trouble across Africa. They're alleged to have paid bribes to get the Iranian cell phone contract. The government of Nigeria keeps whacking them with fines, and other companies with tax evasion. And we identified them as a problem years ago. Even though they have a battleship of an income statement and a balance sheet, AA+ rated by everybody else. And we said, no, they're riskier. We can't assess it. We know they're riskier. They're not below the line. We won't lend to them. But we price them as a single A- credit. We got priced out of the market every time. What a pleasure. They're in trouble. Share price down 30% last month. And we have zero exposure. So price for risk can be done. That's good investment process. It's a sustainable investment process.
And I would add that actually it's a really great question because it differentiates what we're trying to do. And essentially, we don't think of ESG risk as a single pillar. It's another lens through which we look at credit risk, especially in the sovereign and corporate space. So what we've done is really integrate various aspects of ESG into the credit analysis. And then when we're thinking about valuations, we can do something very, very clear in terms of how do various credits across the spectrum look like versus others, and how is that valued in the market? What's differentiating credit A from credit B? Is it something that is political risk? Is it an actual debt overhang issue? Is it a leverage issue? Is it a company character issue? And then we can also think about the triggers in terms of upside and downside triggers in terms of valuation. So you can have latent risks from an ESG perspective that can stay there for a very, very long time. So for a good example is in the Middle East. We know that certain aspects of governance, democracy, representation are very low in certain Middle Eastern countries, but that risk can be latent for a very long time until you have something like the Arab Spring. So for us, thinking about the tail risks becomes very important when we see particularly low scores for ESG, and then also thinking about the deltas from that risk in terms of what can trigger spread tightening or spread widening.
And let me give a plug to both PRI publications and the new CFA PRI publication. So last year, Justin and I co-edited the guide to ESG integration in listed equities, which I think is close to being one of the most downloaded PRI publications. So it's spellbinding. And then the reports that came out today that you can find in the app and you can read on your phone, or you can go home and read it, on a big screen. Again, you've got a whole load of case studies of how different firms are approaching it. So in equities, some people like to adjust discount rates to take into account ESG risk. What I do in my firm is we have a valuation model, but we find the ESG data is useful as an overlay to that.
Maybe in terms of our credit analysis, so the analysts have already a fundamental analysis on a scale of 1 to 5 that they do for all of the financial recommendations. What we've added is a similar assessment that the analysts do on a 1 to 5 basis, where they need to be explicit about how sustainability is impacting their fundamental view. And so ultimately the PMs get an integrated assessment that has clearly what's the fundamental view, what's the sustainability profile, are there sustainability factors that are impacting the fundamental view, and if so, what they are. So they need to explain that clearly. On the equity side, we have a similar approach where the analysts can indicate which of the value drivers have been impacted by sustainability. And obviously you can make adjustments, but I think it's important that it's not seen as an external adjustment, that here are the assumptions, the sustainability looks positive, therefore I'm going to give them a bonus or a discount based on sustainability. It needs to be one integrated approach. And what I think is an alternate way of thinking about it is all of these projections are projections. And there's some really interesting things that you can do in terms of what is the confidence of the projection? What is the, how much faith do you have in management that those projections will actually play out? So thinking in terms of scenarios of what could go right or what could go wrong is much more amenable to the sustainability risks and opportunities which tend to play themselves out over a longer term time frame. And DCF models are by their nature kind of short term in that you've got sort of the current projections over the next 3 years that then often forecasted out ad infinitum. 70 or 80% of the value of the firm is actually coming from those cash flows in future years, but they're often reflecting the assumptions that the analysts have in the short term. So thinking more about more the confidence and the trajectory of those projections, I think, is a more fruitful way of going without kind of re-engineering the DCF process.
So Mary Jane.
I would just add, I agree with a number of the comments that were made that ESG is actually an approach in terms of the inputs that are added to the analyst's view on the company and helps the analyst. So one point I want to make sure that we cover is that we very much from our experience and from speaking with others that valuation is where we get to. So a lot of the work that we need to do prior to deciding whether valuation is attractive or not is related to the strength of the fundamentals, the capital allocation decisions, the quality of management, and speaking to the CEO and the CEF on a regular basis. But it's by sector. So I think it's also important to note that there isn't one approach that goes across a consumer discretionary company to an energy company to a financial services company, that the attention and the weighting of where the ESG factors by sector is very helpful in helping as an additional input to get to the point of valuation.
We have more questions.
Del Anderson, credit analyst with PIMCO. You had mentioned the importance of incorporating incentives into analyst performance reviews, Marianne and Christopher. I want to understand, how do you think about that, particularly for short-term time horizons, and how do you make those positive incentives rather than call it negative incentives?
Yeah, I mean, it's essentially the manager, in most cases the portfolio manager, has to explicitly evaluate the quality of the analyst's sustainability recommendations. Has it really added value? Have they done it consistently across the board? So it's kind of part and parcel of the overall performance review. And the analysts are incentivized on both the annual performance, but over also a 3-year time horizon. So it's a combination of short and long-term incentives. And I think obviously in terms of the financial impacts of recommendations, the longer-term view is absolutely key when you're thinking about monitoring sustainability and actually incentivizing the analysts and then evaluating their performance over time.
Yeah, and the incentives, just to add to Chris's point and also to Andrew earlier, the incentives can be measured in terms of performance review as well. So 2 times a year, the portfolio managers review and rate the analysts on their overall performance, which includes their ESG recommendations and support in terms of research and engagements. But incentive doesn't just have to be about compensation, it could also be about purpose, and that's very much goes back to the culture. So analysts are not only motivated, I'd like to think that analysts are not only motivated by incentive compensation, but very much about what is the future, what is their commitment to thinking as an analyst, but also to help identify where to put the capital so that we can make a change in the future. So in other words, that the analysts are not only just thinking about how I'm going to get measured and paid on this as an analyst in integrating ESG factors, but how does my recommendation and my diligent work on ESG and long-term themes help us in terms of future societal investments and to make sure that we have a world to invest in down the road in terms of sustainable development goals, for example.
Yeah, you have to be very careful setting up incentive structures because people are really good about trying to game them, and it can change their behavior in ways that doesn't help the portfolio or the clients or the firm. Maybe time for one last question. A gentleman over there.
May I'm Axel Zehn, I'm the Chief Financial Officer for the Allianz Investment Management. I've got a question regarding the risk. I think the integration of ESG data in the analyst world, I think the good asset managers had done a tremendous job to get there. I see this. My question would be, let's say, to the next level. Just to make an example, I'm pretty sure you could give me an answer on a company level. What does a 20% water shortage means for company A, B? My question would be, do you also have an experience on a portfolio level? So what does it mean for an investment portfolio if you've got a 10 or 20% water shortage? Just to make an example. Just give me a little bit of ideas of where you are there, because I see there we are a little bit short.
So given Cape Town's recent history, I should know the answer to that question. It's raining this winter, so the dams are filling up. That's good. So I don't know the answer. And when you start talking about that level, what these guys can do in global markets or developed markets like the US with huge breadth and width and depth and liquidity, a lot of the investment theory falls down when you work in relatively smaller markets. So I don't know the answer to the question. I don't think it's something we can practically measure in a single market or even possibly in emerging markets as a whole.
I'm not sure if I understood the question, and please tell me if otherwise, but when you're saying like the water example or data security or any type of ESG factor that might be considered by sector and weighted accordingly, are you asking, could that same factor or issue be impactful to the other companies or stocks that are in the overall portfolio, or are you asking? Right, so water absolutely is an issue that intuitively you would think, okay, for beverage companies it's an issue, but it also comes up for semiconductor and technology companies. It also comes up for food and agriculture companies. So to think that making an assignment of 20% water reduction, it really has to apply by company and by sector. But overall, that water will come through in every single company, that water issue. This is why the SDGs, again, is a sense of giving you a framework of materiality of how do you address in your investments each of those 17 factors. And it doesn't have to be all 17, but many of them. And so it doesn't just have to be at the company level, it does have to be at the portfolio level. So
we're almost out of time.
I know.
So if I may, just quick popcorn round. What is, for each of our panelists, the one takeaway that you would like the audience to come away with? So I'll start with Lupin.
I think the key thing that the audience should take away is that there is a lot of work that's already been happening in terms of integration of ESG, and to ask your investment managers a lot more as to how they're doing that in practice, and that will only elevate the focus on ESG within investment management.
Great. Chris?
Yeah, I guess I would just emphasize that to really overcome some of these barriers, getting the analysts directly involved in the sustainability assessments, recognizing what the limitations of data are and where the analyst job begins, and how they can incorporate this to make better informed investment decisions is the best way to approach this, which we think will lead to higher conviction portfolios, more long-term approaches to investing, and better relations with the companies that we have interactions with.
Mary Jane?
And I would agree with my two former panelists and everything they said, but I would also add that this panel is called Barriers, but these don't have to be barriers, and that we as an industry can overcome those barriers, and there's a lot of support and help, and through the PRI and the CFA Institute you can get help.
Great. And Andrew?
So just to reiterate, all of us, I think, are agreeing that it's all about building an analytical process so we can to expand our repertoire, our tool chest of analytical tools for all of our portfolio managers and analysts, so that we can have good performance and our clients can do well and do good at the same time.
Great. So huge thank you to Justin and to Matt Orsag for the publications. Please check them out. And thank you, panelists, for a lively panel.
Great.